Maybe if I start from a very kind of high level view on who the heck capital preferences even are. So from a very high level view, capital preferences was founded in 2014. Predominantly, we started out in the enterprise space. So some of our bigger clients globally are the likes of JP Morgan and Merrill Lynch. We launched this tool, which is what we call our risk profiling suite in Australia last year. We've had really, really good uptake from advisors so far, and obviously just growing more every week. Our main goal at Capital Preferences is to basically help you as advisors to better understand your clients. So we've got a range of different tools that are available globally that range from ESG preferences, values preferences, liquidity preferences, retirement income preferences. But what we're here to talk about is our risk profiling tool. So our risk profiling tool is very, very different to your traditional risk profiling tool, be it a Phonometrica of the world, a paper-based tool, or just a conversation like you're having, Matt. Basically, what really makes us different is our revealed preferences framework. So traditional tools will use what we call a stated preferences framework, where basically the client will state their preference by answering, a few tick boxes, and basically stating how comfortable they are with risk. That is not actually a very robust way of measuring a individual's behavior, because we know that people can say one thing and then act a completely different way when push comes to shove. So the revealed preferences framework is really the backbone of everything that we do, to fully understand how an individual is actually going to feel during real life market volatility. So the research backing is really the foundation of everything that we do. Dr. Shahar Kareev, who you can see on the screen, he's one of our co-founders. He's also our chief scientist, and he leads our research team, who are based out of Berkeley in California. If there's anything that you take from this session, this is probably a big piece of it, in the sense that our research is second to none, one of the best research teams in the world in regards to behavioral science. Shahar has been the chair of the economics department at UC Berkeley twice. His work has been adopted by some big names like the US Air Force, the National Institute of Health in the US. So really what I'm trying to say is that we're not just guessing where a client is comfortable. Given our really robust scientific methodology and the math that sits underneath the tool, we're able to actually understand where they are, which of course is just going to benefit the advice that you can give and include that whole hyper-personalized approach to science. Don't worry too much about the mathematical and science nature of it, because the tool is very, very seamless. You don't have to be a math whiz to understand it, and neither do your clients. So what we do is we essentially take all of the research from our research team and have built the risk profiling suite around it. So the top point of this pyramid here, obviously the preferences, is what we use through our risk activity to gain exactly how the client is going to be comfortable. From there, we think it's equally important to have that really robust conversation with the client and discussing any constraints that they have and any goals that they have, because what we find is that just because someone is a particular kind of investor doesn't necessarily mean that that is exactly the kind of portfolio that they need to be in. And I'll talk a little bit more about when I jump into a product demo in just a moment. So as a very high level view, just before I do jump into a demo, to give you a bit of an understanding of the three components of the suite. So the first component is the risk activity. This is the client experience. So the client will jump in, they'll answer 6 hypothetical trade-off decisions in our 90-second activity. And this activity actually has a 95% unaided completion rate. So it basically means that you guys can send this activity off to your clients and have full confidence that they can actually complete it independent of the advisor being present. I do always say when I'm training advisors up on the suite that if you had any clients who were maybe of the older generation, maybe a bit tech anxious, you can get them to complete this with you in person. Given that it only takes 90 seconds, you're not going to be spending 10, 20 minutes going through a clunky risk profiling paper-based tool. So really, really nice and seamless. The other great thing about the activity in itself is that it's actually browser based. So we know that people have a bit of app fatigue at the moment, so trying to get away from that. They don't even need to create any logins. All they need to do is click on a link that you send them that is personal to them and create this experience within this 90-second time frame. So really quick for the client. The next portion is the conversation piece. So exactly like what I just said before, although we might find a client is particularly comfortable in one portfolio, it doesn't necessarily mean that that's the best one for them. So this investment meeting is what you would launch with the client being present. You can do it either virtually in screen share or of course launching with them in person in your office. The real kind of design of the investment meeting is to educate the clients. So teaching them a little bit about themselves, maybe some things that they didn't know about themselves before they completed the activity, walking them through different types of goal achievability, and then ultimately having that conversation on which is the best portfolio for them. Third piece, oh, sorry, is there a question there? I don't know if someone's trying to ask a question. Maybe if you can just pop yourself on mute just so we don't get a little bit confused.
Yes, sorry, they were just on mute.
That'd be great.
Unmuted, so on mute now. Great.
Perfect. So the third piece of the risk profiling suite is your validation tick. So the summary report is a PDF document that you can print out, you can pop it into your statement of advice. We often hear advisors actually sending this to a client. This is really here to validate all the conversations that you've just had with the client and justify basically why you've put them in the portfolio that you have. One of the great things about the suite, and this is kind of piggybacking off of the session that I hosted with you guys in May, is the ability to actually profile a couple. So if you had a couple coming to you and they both wanted to invest in the same portfolio, what we actually do is we get both individuals to complete a separate risk activity, and then we actually combine their results to provide them with one joint portfolio recommendation that's essentially maximizing their individual comfort scores. Before I jump into a demo, last thing here is really the 4 main steps of the process to the risk profiling suite, just so you guys can get a little bit more of an understanding on how it would actually slot into your existing process. So step number 1 is that either you or your support team would be sending an invite to the clients to complete the risk activity. Step number 2, the client's going to receive that invite. They're going to jump in either independent of you or with you, and they're going to make those 6 decisions during the activity. Step 3, you're going to be notified when the client has completed the activity, in which case you can move on to step 4, which is going through that investment meeting with them and discussing everything that we've just learned about the client. Okay, let me jump into a demo of the actual tool itself. Share my screen again. Cool. So what you can see on my screen is what we refer to as the advisor portal. So this is only accessible to you as advisors. The clients don't see anything and they will not see anything unless you decide to share it with them. So what you've got the option of doing is, first of all, either creating an individual or importing your clients. I'm going to skip over that session just in the interest of today. But what I've done is already set up a household here just so I can walk you through what the experience looks like for a couple. So in the household that I've already created, we can see that one individual has already completed the risk activity and the other individual needs to be sent the invitation. So this is step number 1. Of course, typically you'd be sending this to both individuals at the same time. So to send the invite to the client, you've got the option of either sending the invite directly from the portal here, in which case Dave, our client, is going to get an email from you. It's going to have a bit of a blurb on what risk activity is, and of course the link. And the other option, and to be honest, more kind of preferred option with most advisors who use the tool, is actually by copying the link. By copying the link, it's just giving you full autonomy on how you actually want to introduce the activity to clients. Some advisors will be copying, pasting this into an email and typing up your own brief. Some people will paste it into a text or a WhatsApp. It's completely up to you. So let's say we've copied that link and we've pasted it into an email to our clients and hit send. The client will receive that, they'll click on the link, and as we can see, it will open up in their browser. So like I said before, it's browser-based, there's no apps for them to download, there's no logins for them to create. All they do is click on a link that you send them. It's personalized to the individual client, and they'll see that they're being asked to take part in a short activity. So hitting the agree and begin button, the first thing that the client will see is their investment amount. Now, because I'd already created the client in our portal here, I've already entered in an investment amount here. If you don't know how much the client has to start off with, you can leave this blank and the client can jump in and change it themselves. This figure does not have to be precise. It just needs to be somewhat realistic to what the individual is working with, because this figure is going to personalize the activity to them. Next up, they're going to get a few brief instructions. They'll see that they're going to make decisions in 6 different hypothetical scenarios. And in each scenario, they choose how much of their principal they're going to put at risk when they're offered different levels of returns. So starting the activity here, the first thing that the clients will see is to move the slider. This just gets people comfortable because this is what they're going to be doing in each of the 6 rounds here. So starting at the top here, we can see that the question is asking, how much would you risk if for every $1 risked, you could potentially gain $3.50? What we actually do in each of the 6 rounds here is we change this potential to gain. And by changing that potential to gain, we're able to measure if the client is willing to take more amounts of risk when that opportunity to gain is greater and less if it decreases. What the client's also got the option of doing is toggling between the dollar value and the percentage. So just depending on what works best for them. They'll see how much they're willing to potentially lose, how much they're willing to potentially gain, and importantly, that each outcome is equally likely. So just by way of example, if the client was to move the slider all the way to the left-hand side here, we can see that they're saying that they don't want to risk any of their principal, so none of that $1 million. But of course, that means that they're not going to potentially gain anything either. Of course, opposite to that would be moving the slider all the way to the right-hand side here. And the client would basically be saying in this case that they are happy and they're comfortable to risk everything that they came here to invest with, to potentially gain 3.5 times that in this particular round. Underneath the hood is where all of that math comes into play. So wherever the client chooses on the slider is going to give us a good indication of what kind of investor they are and what kind of behavioral preferences they have. It's important to note that there's no right or wrong answer if a client is selecting all the way to the right in all the rounds, or all the way to the left in all the rounds, or somewhere in the middle. There's no right or wrong answer for the client, just wherever they feel is most comfortable for them. When they have decided where they are comfortable in the first round, they're going to hit that next scenario button. They'll see this pop up that is really notifying them of that changing investment condition that I talked about earlier. So hitting continue, round 2, we can see that the client is willing to risk $1 again, and they could potentially gain $2 in this case. So we've dropped it down from $3.50 to $2. So is the client going to take a similar amount of risk in the previous round, or actually, given that the opportunity to gain isn't so great, are they actually going to decrease their money? So it's completely up to them again, wherever they feel most comfortable. This is exactly what the client is going to do in each of the 6 rounds here. I'm just going to whiz through the rest of the activity here. Generally, we often find that clients will spend about 20 seconds or so on round 1, just as they get comfortable, and then they tend to speed up as they move throughout the 6 rounds here.
Claire?
So again, go for it, Caroline.
Is there a time frame? So you're saying $1 that they risk, but there's no set time frame. So when the clients are going through this, what do you respond?
Yeah, so there is actually a time frame. So we can see
over the next year. Sorry, I missed that one.
No, that's all right. That's all right. The reason why we don't make it super clear in the question itself of, over the next 12 months, how much would you risk, is because the time frame ultimately doesn't matter. If a client is willing to take more amounts of risk when the opportunity to gain is greater, it doesn't actually matter on the time frame, but we have included it for those few clients who might question on, but when is this realistic? Is this realistic? It's important to note that this is a hypothetical scenario. So as we know, taking, X amount of risk to potentially gain 5 times that over the space of a year is pretty unrealistic. So it's not exactly the figures that we're looking at. It's more so the behavior. But yeah, great question, Caroline. So when the clients answered their final activity here, they're going to hit that finish button, and soon they'll get a bit of a thank you message pops up. This is really to notify the clients that they've finished the activity. They can exit out of that browser and move about their day as normal. So what you will then get is an email that notifies you that the client has completed the activity. So if they've been completing it independent of you, you're going to get that email notifying you that they've finished. Typical workflow would be that if you had a client coming into your office next week, you'd be sending them the invite to the risk activity this week and asking them to complete it ahead of your session. Let's say week rolls around, the Williams household are in your office, and you're ready to actually present the results with them. Hitting that present results button on the client's page is what is going to launch that investment meeting. So this is really that conversational piece. The purpose of this is to have that robust conversation with the client. It typically takes about 10 minutes or so for most advisors to run through it. However, some advisors like to spend 30 minutes to an hour in here. It just depends on the questions that the client has and the conversation that you want to have with them as well. There's also a couple of areas in the whole experience that we can white label it. Down the bottom left-hand side as one of them, where we'd put your own logo. So starting off, a bit of an agenda is really here to let the clients know the purpose of the session, what it is that we're going to be running through with them. First thing that we'll see is our risk dimensions triangle. So exactly the same triangle that I just walked you through in that slide deck before. Of this being here in the activity for the client to view as well is really so that you as the advisor can sort of set the scene with the client. So regardless of if it's a new client or an existing client, it's about giving them that foundational knowledge on what we're here to talk about and why. So clients, thank you for completing the risk activity. Today we're going to look at how you actually made decisions, what kind of investor you are, what kind of portfolio is going to be the most suitable for you. But equally, I'm still really keen to learn about any goals that you have and any constraints that you have, because ultimately that is going to affect the portfolio that we select. And in order for me to personalize my advice to you, I do want to have this conversation. On the the right-hand side, we've got some talking points here. This is also available for the clients to view as well. It's really here as your sort of backbone to kind of lean on if you got a little bit lost as you're getting familiar with the tool. It's got a few prompts in here and a few questions that you can start asking the clients as well. Next up, we've got the decision patterns. So because we've got a household who have completed this, we can see both of their results. Naturally, if we just had an individual, we'd just see one. What we've actually done here is we've rank ordered those 6 decision rounds from the highest opportunity to the lowest opportunity. And what we're trying to see here is if the clients took more risk in the higher opportunity rounds and then less risk in the lower opportunity rounds. As an advisor, this is your immediate snapshot into if the clients have got a good understanding of risk and reward. Have they taken more in the higher rounds and then less in the lower rounds? Or actually, are they all over the place and we're not really sure why they've chosen what they have? This is your initial point to have that discussion with the clients on why they made the decisions that they did. Did they know that each other had different preferences? Because as we know, 60% of couples are going to have a meaningful difference in their risk preferences. So here I'd be starting to compare. So Sarah, Dave, tell me a little bit about why you made the decisions that you did. Dave, tell me why you took the most amount of risk when the opportunity to gain was the highest, and absolutely none when the opportunity wasn't so great. Did you just not think it was worth it? Walk me through what you were thinking. And maybe Sarah's thinking, gosh, why didn't he take any risk? I still took a decent amount of risk. So you can really imagine how the conversation can start to unravel for both particular clients in that household. Next up is where we actually look at that individual attitude to risk scores. So of course, attitude to risk here, we're measuring how comfortable the clients are with taking risk during the activity. Best way to read this particular report is through these scores at the top right-hand side here. So the higher the risk score an individual has, the more appetite for risk they have. And what we can also see is, just to make your life easier, we've split it up into low, mid, and high ranges, just so you can see at a glimpse which area the clients have slotted into. For our particular case, we can see that Dave has got a really high appetite for risk, whereas Sarah is sitting in that kind of mid-range. What you can also see is this blue shaded bell curve in the background here that's actually showing a global representative sample of everyone who's completed the risk activity. So this is based on about 700 to 800,000 clients who've gone through our activity globally. What we found is that some clients do really like to be compared to other people. They want to know what is considered normal, what's considered not normal, and sometimes they like to have that conversation with their advisor. Some clients couldn't care less. Of course, you'll know your clients and how to have that discussion with them. Next up is where we look at their sensitivity to loss. So how comfortable is the client with losing money? The sensitivity scores up the top right-hand side here, the best way to read these, at the higher the sensitivity score an individual has, the more nervous they're going to be when markets do become a bit volatile. Again, we've split it up into composed, somewhat unsettled, and unsettled. And here what we're trying to see is how the client is likely going to react during those times of market volatility. What we can see is that Dave has got actually a fairly decent amount of sensitivity to loss. So really the beauty of being able to split up an individual's preferences in regards to their attitude to risk and sensitivity to loss is to see exactly this. Just because someone has got a high appetite for risk doesn't necessarily mean that they're going to be comfortable when the markets do become volatile. So the ability of actually walking the client through that you know what they're like and that you can plan around that is going to give the clients a lot more confidence that you actually know where they're comfortable and that you're not just guessing based on a 5-minute conversation or a simple tick the box activity. What we often hear feedback from is in regards to clients who have gone through this experience and have informed their advisor that they were happy that they went through this particular screen on the sensitivity to loss because they felt more comfortable that their advisor actually knew where they were sitting, and that when markets do become a bit volatile, even if they were in a portfolio with a lot of growth, they know that their advisor's got their back and knows what they're like, so there's no panic. What you will also see is that the most common sensitivity score is actually 0, which is exactly where Sarah's come out as. As I said at the start, there's no good or bad scores. Any score is an insight into the client's behavior. With those who've got a sensitive score of 0, it's likely that when they've actually answered the activity itself, they've had a set range in their head that they're not willing to move out of. So when they're actually moving the slider, maybe they don't want to lose a certain amount of their principal, and they're never going to be moving the slider outside of that range. That's a perfectly rational way of investing, so it's not something to be concerned about. It just means that these individuals have a rational way of investing and that they know that there's always a loss component to risk. Next up is where we actually connect their preferences. So what we've done here is we've actually taken all of the model portfolios, put them on an efficient frontier. Of course, this is just my demo environment. So what we would do for each of you guys is we would take all of your model portfolios, put them on an efficient frontier as defined by your own capital market assumptions. So everything down to the portfolio name, the expected return, volatility, and the actual asset allocation of those portfolios is fully configured to you. So just keep that in mind as we go through the rest of this experience here. Of course, in our demo environment here, out of each of the 6 portfolios, we can see the best portfolios for these individuals. What we're showing here is that based on how Sarah made her decisions, she is going to be the most comfortable in the moderately aggressive portfolio, whereas Dave as an individual is going to be the most comfortable in our high growth portfolio. For a couple, what we then do is we actually combine their individual preferences to produce an individual portfolio that is essentially maximizing their individual comfort scores, which in our household here, they are going to be the most comfortable in the aggressive portfolio. Of course, this is just a really nice looking example for this session today. It's not always going to look like this. You might have 2 clients who are portfolios right next to each other, and which of these 2 portfolios, or maybe even one above or below, which ones are the most comfortable for them as a household. What you can also see is the risk zone here. So this blue shaded area in the background here is taking into account the portfolios that have a 60% or higher risk comfort match. To explain that in a little bit more detail, and again, you don't have to go through any of this detail with the clients if you don't want to, it's purely for your own knowledge. You can toggle over to the table view here, in which case we can see all of our risk comfort scores against our portfolios. Darren, you've got a question. I'm going to pause and let you answer. See your hands up.
Thank you, Claire. I think the assumption here is that there's a single pool of money as opposed to 2 pools of money. Is that correct?
Correct.
Because otherwise
Correct.
you would simply invest the funds as per the individual's profile.
Exactly. So in that case where we've got maybe a household like Sarah and Dave in this example, who have got a combined pool that they want to invest in, but maybe Sarah and Dave both have individual buckets that they want to do separate things with. What we would actually do, Darren, is they would complete the activity based on that pooled amount, just like we've got here. And then we would also set them up as individuals in the suite against their own investment amount. So maybe Sarah's got 500,000, maybe Dave's got 200,000. Based on those individual amounts, the client is going to take a different amount of risk depending on what it is that they're wanting to do with that. So there's lots of different variations depending on what the client's aim is and how they actually want to invest. That's a great question though, Darren.
Thank you.
Perfect. So these risk comfort scores, if you look at them as a 0% as the worst possible alignment for our household and 100% as the perfect match, here, of course, we're always going to see the highest percentage of risk comfort is always going to be where we recommend them as a household. What we can also see is the other portfolios that they are most comfortable in. So remember, the comfort zone is looking at portfolios that have a 60% or higher risk comfort score. That doesn't mean that if a client has got a risk comfort score of 59% for a portfolio, that they're going to become suddenly uncomfortable in that portfolio. It's more so just a guide for you to walk them through the other options that they have. What we can see for our case here is that, yes, most comfortable as a household in the aggressive portfolio. Actually, the next best portfolio for them is actually the high growth portfolio here. The reason why this has happened is likely because the way that they both individually answered the activity. Sarah was pretty composed with loss, but she also had quite a high appetite for risk. She was sitting in that mid-range. Whereas Dave, on the other hand, had a really high appetite for risk, but he was still, a little bit nervous about losing money. With this, we've taken both of their results again, combined them, which is why Sarah is happy to move up than Dave is to move down, given that he had a really high appetite for risk. What we then start to do is map them and kind of discuss this goal achievability. So, okay, you're both comfortable in the aggressive portfolio. Let's actually see if you're going to reach any goals that you have in that particular portfolio. This is really where it can be a perfect example of walking the client through where they actually need to be versus where they may be comfortable. The example I always use is that if you had a 30-year-old investor coming to you for the first time, and through completing the activity, we find that they're a conservative investor. Given their time horizon, I'm sure not many of you would actually be putting them into a conservative portfolio. So this is really that next step of guiding the client through, okay, this is how much risk you're comfortable taking, but let me just walk you through how realistic it is that you're probably not going to reach the goals that you want if we keep you in that portfolio. Jumping down the bottom right-hand side here, we've got the option to launch the goal projector, and this is definitely the most favorite feature of the whole tool. It's the piece that we get the best feedback on from individual advisors in Australia to those big names like JP Morgan. What we've got the option of doing is walking the clients through a different goal. So it's either retirement income or wealth accumulation. You can walk them through both if you want to. I'm going to jump in and show you the retirement income one. So when it loads up here, what we'll soon see are some fields to enter some data into on the left-hand side. So again, you can imagine how this becomes even more interactive with the client. If you've got them sitting down with you in person, give them the device, let them plug in different numbers and basically see what the output is. Let's say for this particular household, they've got a retirement income goal of 110,000 per year. Investment amount is how much they started off with, so how much did they use to complete the activity. Let's say that they're going to contribute another 30,000 a year. Let's say they're going to get 25 from their pension. Maybe they've got a bit of extra cash on the side from a rental property. And let's say they're both happy to retire at the age of 65. Hitting that update button, what we'll soon see is the likelihood that they will actually achieve this goal in each of the portfolios. So again, bearing in mind that this would be fully configured to you and your portfolios. First of all, retirement goal here, that's of course 110,000 in this case. Each of these bars are showing the forecasted outcomes of investing in each of these portfolios. And goal match is showing the lowest level of risk that a client needs to take in order to reach their goal. And of course, highest risk comfort is the portfolio that we found that they are most comfortable in as a household. So this is a really good outcome, right? The clients are easily going to reach their goal in any of the portfolios above the conservative. This is all run on Monte Carlo simulations, so we are pretty confident that this is a good outcome. Of course, it's never going to be 100% guaranteed. We do take into account things like life expectancy and inflation, but we don't take into account things like tax. So just walking the clients through the fact that this is hypothetical, but it can really help with that visual demonstration of where they want to be versus where they maybe need to be. Of course, you can imagine this gets really, really conversational. The clients might say, okay, well, maybe what if we had a bit more of an ambitious goal? Okay, what does that then look like? Without changing any of the other data points, we'll soon see that, okay, they now need to be in this particular portfolio. Maybe Sarah then says, okay, well, what happens if we actually both wanted to retire at 60? What does it look like then? Is that a possibility? And we can soon see that by pulling and pushing some of the levers on the left-hand side here, we're able to create this plan that is achievable and gives the clients confidence that they actually have got a good amount of achievability for this particular goal.
Claire,
Might also go for it.
Question. So we've got here the amount of income that they're trying to get in retirement.
Yes.
And we're saying at what time they're going to retire. Have we got an idea of what money they're going to have at retirement at this point in time?
So we've got another projection that I'm just about to jump to in a moment, which is pretty good for walking them through how likely draw down on their money over time.
Because how do we know whether they're going to have $25,000 in age pension if
so
we don't know how much money they've got? If they've already got $1 million at 40 years old.
Yep, so this is just your ability to visually demonstrate. So any tools around how you'd actually calculate this are still to be done, using your own whatever tools that you're using. We are looking at building out the calculations in this particular tool here. Just bearing in mind, Matthew, that this is not the be all and end all. It's a visual representation of that goal achievability. So if you did need to go into that kind of more granular detail, definitely do that in any other tools that you have.
Yeah.
Cool. So the next portion is really walking the clients through. Of course, we know if the goal is achievable, but then how are they likely to draw down on that money in retirement when they get to those retirement years? So a perfect feature for those clients who are either already in retirement or maybe close to retirement. Toggling that already in retirement button, we've reached our retirement drawdown projection. What we're showing here, of course, each of these bars here are each of the portfolios, again, fully configured to you. And what we're showing here is the year in which that legacy money, sorry, not legacy money, the year in which we're going to spend down on that money. So really helping them plan around, passing away with money left in the bank, basically. We've also got the option of walking the clients through how likely it is that they will need to dip into any particular fund that they wanted to leave behind for let's say, the grandkids. Adding in that legacy goal and then actually toggling to the table view up here is where we can walk the clients through. Hovering over each of these years, we're showing the year and the age in which that legacy money may be required. So of course, we're really hoping for an outcome where they're never going to need to dip into this legacy money. This is really just giving those clients that confidence that they can actually spend that money in their retirement years. They can go out for dinner once a week, they can go on that holiday. They don't have to worry about not having anything left for grandkids when they pass away. Last piece here is actually selecting the portfolio. So again, fully configured to you guys, all of your own portfolio names here. Let's say this particular household do decide to go into the aggressive portfolio. We hit that finish button. We have a little next steps note here. This is really great for if you wanted to add anything for compliance. Anything that you record here will be shown on that post-meeting report, so that PDF document. It's great that if you had the case of that 30-year-old client of they were comfortable in this portfolio, but we've put them in this portfolio for X reasons, it might be something that you want to discuss with the clients next time you meet with them. So in a year's time, you want to discuss how we're going to fund their kids' university, whatever it may be. Next meeting is, of course, when we're going to re-profile the client. So I'm just going to keep it to that 12-month mark. Hitting that generate report button is where we come to a close of this session. So you can see you can run through it pretty quickly. You can spend a lot of time in it, just depending on how much information you want to go through with the client. If we toggle to our advisor portal again, only you guys will have access to this. Immediately on the client's profile, we can see the portfolio that they selected. A little bit further down here, we've got some score trends on the client attitude to risk and their sensitivity to loss. So a really great tool to be able to walk the clients through how they're actually changing over time. So this year we can see where their scores were. Next year when we profile them, how are they going to be comfortable? One thing to note here is that although we recommend reprofiling on a regular basis, that doesn't necessarily mean 3 months or 6 months. We would, however, recommend reprofiling clients on an annual basis. All you need to do is simply send the clients the link and get their results. You don't have to go through that whole investment meeting. You can quickly see here if their preferences have changed. If they're pretty similar to where they were last year and the clients don't have any new goals, you can probably just give them a call and say, Sarah and Dave, preferences look pretty similar to last year. I'm happy to give it another year before we reconnect. Last thing here is, of course, the reports, that PDF document that is there to validate everything that we've just discussed with the client. Here is what would typically be printed out, downloaded, popped into your statement of advice. One thing that you'll also notice is that we've removed all of the financial jargon from this report. So if you did want to send a copy to your client, they can actually understand it outside of you being present. It's a really nice take-home piece for clients if you want to print it out and give it to them at the end of the session. Here we go through everything that we've just discussed with the client, so how they made decisions, attitude to risk, sensitivity to loss, mapping them to one of your portfolios, and then finally what goal projector we ended on. One thing I do just want to quickly finish on here is in the advisor portal, you've got the option of having a look at where your entire client base are sitting. So this is really a game changer for you to actually determine where your clients are comfortable. And if there is a time of huge market drop, you know which clients are going to be more sensitive and who to contact first. Of course, each of these dots are one of your clients here. I'm going to stop sharing my portal here and get my little slide deck back up for everyone. Oh, I need to share my screen again. So just a few last points here. Obviously, the environment that I just went through is a pretty good outcome for goal achievability and also what kind of investors these clients are. Just wanted to run through a few examples of what your clients will also like, so that if you do end up joining, you're not panicked if a client comes out as something completely different than what I've just shown you. So Penny's a pretty average investor. She's taken more risk in the higher opportunity rounds, less in the lower opportunity rounds. Daniel, pretty similar to Dave in my example before, he's taken the most amount of risk in the higher rounds, less in the lower rounds. But you're also going to have clients like Frankie, who are what we call inconsistent. It is worth noting that out of the 700, 800,000 clients that have gone through our suite, only 2% of them have come back as being inconsistent decision makers. If your client does answer the activity inconsistently, it's a flag to you immediately that the client's either not understood the activity, they've maybe not been paying attention, or they just don't have a good understanding of risk and reward. You will be notified as soon as they've completed the activity if they are inconsistent. In any case, we would always recommend having that discussion with them, trying to find out if there was a particular reason, if they struggled with the activity, if they just didn't understand that whole risk and reward concept. We would always recommend that they complete the activity again. If they come back as inconsistent again, it's a bit of a flag to you that you need to have that educational conversation with them on why it is that they took the amount of risk or not amount of risk as you would have anticipated. Of course, as I just went through the whole investment meeting with you guys and then the report, you don't have to follow this particular process. That's just the whole suite as an overarching view. Some advisors don't go through the investment meeting at all, and they simply just download that report that gets generated as soon as the client completes the activity. It's option kind of to you on how you want to launch the experience, whether you go through that investment meeting or you just stick with the report. The last thing here before we finish up for today is if you guys do want to jump in and test the suite out for yourself, we offer 30-day free trials. So it gives you the ability to jump in, do some testing, test it on yourself, test it on your friends and family, test it on a couple of your clients that you have a good relationship with. After that, pricing for the suite is $99 per advisor per month. That gives you unlimited usage of the suite. I will be flicking everyone who registered to this an email afterwards, just if you wanted to have a one-on-one session, go over any initial questions that you have or some more training. Welcome to contact me on that email at the bottom there. Otherwise, feel free to reply to the email that I ping you all today. Caroline, I'm going to hand it back to you and stop yapping. and hear if anyone has any sort of immediate questions just for the last kind of couple of minutes.
Lovely. Thanks, Claire. There's a lot to consider there, and amazing. And thank you for the offer of the free trial. I think that there may be a couple of people who'll take you up on that as well. Does anybody have any questions?
I'll kick off with one, if that's okay. Darren again. Claire, apologies if you mentioned this at the beginning. I was a little tardy in joining. How long has it been available in Australia, did you say?
Yeah. So good question, Darren. Yeah. So Capital Preferences has been around since 2014 with the risk profiling suite. We launched in Australia last year, so May 2023. So just over a year and a half in Australia.
Okay. My purpose for asking that specific question was whether or not any of your clients that have been using it have had the unfortunate experience of having to defend any advice in AFCA, and whether your program was used, and any, I guess, insights that you have around AFCA's I guess, thoughts about the process, and if you can shed any light on the outcomes of complaints that may have been made, if you wouldn't mind.
Yeah, good question. So no is the short answer. No one who's used our suite has come into that unfortunate event. I do always say though that we are pretty confident that what we have would hold up in that event of a dispute or the likes. We do have Danielle Press on board at Capital Preferences, who was the ex-commissioner at ASIC. She has been a bit of a North Star in making sure that we are as compliant as we possibly can be. Of course, our tool is used by those bigger names, Merrill Lynch, JP Morgan and the likes. And of course, they go through rigorous compliance testing as well, and we've passed all of it. So we are pretty confident that what we have would hold up. But I can't really give too much detail around that, Darren. Sorry, we don't have specific examples that I can share.
That's okay. What about any offshore regulators, given that you've been playing, in the space for a while offshore?
Yeah. So that's a completely different ball game, given it's in that more enterprise space. I'm actually not across any of that, Darren. So
Okay.
even if I knew, I wouldn't be able to share with you anyway.
No, that's okay.
But yeah,
Thank you.
Happy to find out some more information on any of that if you're curious to hear on that kind of offshore regulation that we've been through.
No, that's okay. Thank you, Claire. Appreciate the honesty there. Thank you.
All good. Any other questions from anyone?
Awesome.
Cricket's chirping.
Yeah. If there are any questions, please don't hesitate to send them through to myself or to Claire. We are supportive, as you all know, of using new technologies or anything that can help you with your clients, and have that demonstration that you've gone through the steps to confirm with the client how they look at risk and how they how that affects their investment styles. So anything that we can demonstrate is amazing, and will absolutely be supportive in, should there, knock on wood, be anything that goes astray. And we've certainly had that in the past, where we've had an advisor who's been able to demonstrate how they've gone through risk profiling, and that's stood in their stead, and really was that saving grace for them in that that situation. So anything that you can demonstrate is amazing. Incredible session. Thank you, Claire. Really appreciate your time today. But yes, if you've got any questions, shoot them through to me and we can go from there. Otherwise, contact Claire directly. If you want to take up that offer, they come directly to you, Claire?
Yep, that's it.
Lovely. Great.
Wonderful.
Thanks all.
Thanks for your time,
Appreciate
everyone. Thanks, Caroline. Cheers.
Thanks.
Bye.
Bye.